Welcome to the Deep Dive. We're here to cut through the noise and get you straight to the insights that matter. Today we're diving into Plug Power, a company, really right at the forefront of this whole hydrogen economy thing. So our mission today is to unpack their latest financial results, the second quarter numbers. We're drawing heavily from a really insightful article by Matt DeLallo over at The Motley Fool titled Plug Power, A Long Road to Profitability. And the goal isn't just reciting numbers. We want to understand what they really mean for a company in this kind of high growth, but, let's face it, super capital-hungry sector. Okay, let's unpack this. Right, so to really get a grip on where Plug Power stands, we should probably start with the positives, the bright spots in their latest report. Because, well, amidst all the challenges, there were some real signs of progress, things moving in the right direction, like revenue. They booked, $174 million in Q2?
That's right, and that's up 21% compared to the same quarter last year, so solid growth on the top line.
And what's actually driving that? Is it across the board?
It seems to be pretty broad-based, actually. Strong demand for their core products. You've got the GenDrive fuel cells, those things powering forklifts and the like. Then there's the GenFuel hydrogen infrastructure, the delivery side. And importantly, their Janico electrolyzer platforms. Those are key for actually making green hydrogen.
Right, the production piece.
Exactly. And that electrolyzer part is interesting revenue there. Apparently tripled year over year.
Tripled, wow.
Yeah, hit $45 million as they've been expanding globally. And what's fascinating here, I think, is that this signals genuine market traction. It's not just projections or, hype. People are buying the actual hardware.
The nuts and bolts.
Precisely. The fuel cells, the infrastructure, the electrolyzers. It shows there's real demand developing for what they offer.
Which is crucial in a sector that's still, developing itself.
Absolutely. It's the kind of tangible progress you want to see beyond just flashy announcements.
Okay, now moving on. This next number really jumped out at me. Gross margin. Seeing it improve from, negative 92%?
Yeah, a truly staggering negative 92%.
All the way to negative 31%. I mean, that's still negative, but
yeah.
Wow. Here's where it gets really interesting. What's behind such a dramatic shift?
Well, several things feeding into it. Higher revenue helps, obviously, but they also point to reductions in service costs, improvements in equipment costs, and better pricing on the hydrogen they supply.
Okay, so multiple levers being pulled.
Right. And this connects directly to their big internal initiative, doesn't it?
Project Quantum Leap.
Exactly. If we look at the bigger picture, this margin improvement seems tied to that structural cost-saving effort. And it's not just trimming fat, we're talking workforce optimization.
Which often means layoffs, right?
Right, it can, yeah. Also consolidating facilities, cutting professional services, software costs, renegotiating supply deals.
A pretty major overhaul.
It really is, a complex undertaking. And a key win under that Quantum Leap umbrella was extending a major hydrogen supply agreement with a big U.S. industrial gas company. They locked that in through 2030.
Okay, so securing supply, potentially at better costs.
Exactly. More reliable, lower-cost hydrogen is crucial for their model. That definitely helps de-risk things a bit.
And all these improvements, the cost savings, the better margin, that impacts their cash situation, presumably.
It does. The direct positive outcome was a significant reduction in their cash burn rate.
How significant?
Over 40% lower compared to last year.
40%. Sounds like a lot. Gives them some breathing room, maybe. Less pressure to raise money immediately.
It certainly helps. Lessens the immediate need, perhaps. But let's transition to the challenges, because that reduction doesn't mean the problem is solved.
Right, because that gross margin, even improved, is still negative 31%.
Exactly. They're still spending more to make and deliver their products and services than they're earning from them.
So even with lower burn, they're still burning cash?
Definitely. That negative gross margin inevitably leads to continued cash consumption.
Do we know how much they actually burned through recently?
Well, the article notes they consumed about $385 million in cash just from investing and operating activities over the past 6 months.
$385 million in 6 months.
Okay.
So, yes, the burn rate is down, but it's still substantial.
Which explains why they still needed outside capital despite the improvements.
Absolutely. You saw them sell, another $280 million in stock back in March?
Right. And then they also closed that big credit facility in May.
The $525 million secured credit line. Basically borrowing against their assets to, plug the hole in the balance sheet.
So where did that leave them in terms of cash on hand?
They ended the second quarter with $140 million in cash.
Okay, and access to more debt.
Yeah, over $300 million still available under that credit facility.
So $140 million cash plus $300 million debt capacity. Sounds like a cushion, but
But if we connect this to the bigger picture, given that $385 million burn over 6 months, that current liquidity, it only covers them for maybe a couple of quarters at that rate.
a couple of quarters.
Oh.
That's not a lot of runway. It really isn't. It strongly implies they'll need to keep raising outside capital.
More stock sales, more debt.
Likely both, or at least the option for both, to fund everything until they actually hit profitability.
And they don't expect that until when? 2028.
That's the projection mentioned, yeah. 2028 for profitability.
Which brings us to the impact on shareholders. Dilution.
The unavoidable consequence. Even if they say no more stock sales this year.
The pressure will be on for the coming years.
Almost certainly. You just need to look at a chart of their shares outstanding over time.
Yeah, the source article mentioned using Y-charts data, showing a massive rise.
It's significant, and all that new stock being issued.
Puts downward pressure on the price of existing shares, right?
Tremendous downward pressure. It's why, despite all the potential, the stock has lost. Well, the article quotes a staggering 99% of its value since the IPO back in 1999.
99%.
Oof. It's brutal.
So the outlook, even with improving operations, is that the share price could keep facing headwinds as they potentially issue more stock.
That seems to be the implication, yes. Until they can sustainably fund themselves from operations, that dilution risk hangs over the stock. And the author, Matt DeLallo, kind of sums it up that way.
How did he put it?
He acknowledged the tremendous growth potential in hydrogen, the big picture opportunity, but concluded that Plug Power's long, expensive road to actually making a profit makes it an unappealing long-term investment opportunity. His words, at least right now.
Okay. So what does this all mean for you listening in, trying to get a handle on companies like this?
Well, I think Plug Power is a really potent case study, actually. It perfectly shows both the immense excitement and potential around new clean energy tech.
And the incredibly difficult, capital-intensive reality of scaling it up.
Exactly. It's a journey of making real operational gains, improving efficiency.
While simultaneously facing these huge financial hurdles, the cash pain, the need for funding.
It highlights that the technology itself is only part of the story. Execution and financial management are just as critical, maybe more so.
So the key takeaway is really to look beyond just that top-line revenue growth, isn't it?
Absolutely, especially in these kinds of high-growth, potentially disruptive industries.
You have to dig deeper. Look at gross margins. Are they actually making money on what they sell?
Look at the cash burn rate. How long can they sustain operations?
And understand the impact of share dilution. How much are existing shareholders paying for that future growth?
Those metrics often tell a more complete story than just the revenue number.
A really important perspective when evaluating these kinds of investments.
Definitely food for thought. And perhaps something to leave you with.
Go on.
As you watch Plug Power and other innovators, maybe ask yourself, what does this specific journey really tell us about the true timelines, the actual capital needed for companies to go from exciting tech to sustainable businesses? Even when the market potential seems enormous, what really stands out to you from this deep dive into their financials?